Ensuring a healthy retirement income that can last for many years is a primary concern for most people. But how can dividends help you secure your retirement? The 4% rule is a guideline used by financial advisors to help retirees determine how much to withdraw from their retirement savings each year. It suggests withdrawing 4% of your total portfolio annually. However, during economic downturns or recessions, this percentage might need to be adjusted. During significant economic downturns, advisors might recommend lowering withdrawals to below 3% annually to help sustain your portfolio over the long term. My name is Mich, and I teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Retirees who follow the 4% rule might find that their portfolio balance decreases over time, especially if they live longer than expected. This creates uncertainty about how long their money will last and whether they can continue to live comfortably in their later years. The last thing anyone wants during retirement is to worry about running out of money, especially when health or other factors may limit their ability to work. Thankfully, there are strategies for managing retirement investments that allow you to live off your savings without needing to sell off your principal assets. One such approach is to focus on investments that generate regular income in the form of dividends. By choosing dividend-paying stocks or funds, retirees can potentially live off the cash flow generated from these investments rather than selling shares to cover their daily expenses. Importance of dividends. Investing in dividend-paying stocks or funds means companies share a portion of their profits with shareholders through regular dividend payments. This is similar to earning rental income from a property, with the added advantage that the stock itself may appreciate in value over time. This allows you to potentially live off the dividends, preserving the principal investment and enabling it to grow further. Traditional retirement strategies often involve selling assets to generate income. For example, you might sell part of your stock portfolio each year to cover living expenses. However, this can be risky, especially during market downturns. Selling assets in a down market can deplete your portfolio, making it harder to recover and sustain income throughout retirement. Conversely, living off dividends allows you to keep your investments, which can continue to appreciate. Building a dividend-focused portfolio early is crucial for maximizing retirement income. The sooner you invest in dividend-paying stocks or funds, the more time your investments have to grow and generate income. Understanding how dividends work. When you buy a stock, you become a part owner of that company. As the company grows and generates profits, it can pass those profits on to shareholders in two main ways: through capital appreciation and dividends. Capital appreciation occurs when the stock price rises over time. For example, if you buy a stock for $50 and the price increases to $100, you've gained $50 in value. However, to access that gain, you need to sell the stock. Dividends, on the other hand, are cash payments that companies make to shareholders, typically on a quarterly basis. These payments provide regular income without the need to sell any stock. For example, if you own a stock that pays a 4% annual dividend and you own $100,000 worth of that stock, you would receive $4,000 in dividends each year. The beauty of living off dividends is that it provides a more stable and predictable income stream compared to relying on the sale of assets. As long as the companies in your portfolio continue to grow and generate profits, they are likely to keep paying dividends. Some companies even raise their dividend payments over time, giving you an income that can grow each year. The power of dividend growth. One of the most compelling aspects of dividend-focused retirement strategies is the potential for growing income over time. Many dividend-paying companies aim to increase their dividend payments as they expand. For instance, a company might start by paying a dividend of $4 per share when the stock price is $100, resulting in a 4% yield. Over time, if the stock price rises to $200, the company could increase the dividend payment to $8 per share, maintaining the 4% yield. This means you could receive higher dividend payments as the stock's value increases. While not every company will raise its dividend over time, many stable, well-established businesses do. Take Coca-Cola, for example. It has increased its dividend every year since 1962. Over the past decades, Coca-Cola has averaged a 5% dividend increase annually, which has historically outpaced inflation, typically around 3%. This makes dividend-paying stocks a powerful tool for retirees aiming to maintain or even grow their income in retirement. Choosing dividend-paying investments. For those seeking a hands-off approach, index funds or exchange-traded funds, also known as ETFs, that focus on dividend-paying companies are an excellent option. These funds pool together a collection of dividend-paying stocks, making it easy to diversify your investments. Common examples include S&P 500 dividend funds or high dividend yield funds. The expense ratios for these funds are usually very low, often around 0.3%. which means you're not losing much of your returns to fees. High dividend yield funds, in particular, focus on companies that pay above-average dividends, typically providing higher income for retirees. However, it's important to note that high dividend companies tend to be larger, more mature businesses, which may offer less potential for future growth compared to younger companies. If you prefer to invest in individual stocks, there are many companies known for consistently paying dividends. Some of these companies are referred to as dividend aristocrats, meaning they have increased their dividends for at least 25 consecutive years. Examples include well-known names like 3M, Johnson & Johnson, Walmart, and McDonald's. Another option for high-yield dividend income is investing in real estate investment trusts, or REITs. REITs are companies that own and operate income-producing real estate, such as apartments, office buildings, and shopping centers. REITs are required by law to distribute most of their income to shareholders in the form of dividends, which makes them attractive for income-focused investors. However, keep in mind that REITs often have limited potential for capital appreciation since they pay out most of their earnings rather than reinvesting them. Calculating needs for a dividend-focused retirement. The amount of money required to generate sufficient income from dividends depends on the average yield of your portfolio. For instance, if you need $100,000 per year to live on, and your portfolio yields an average of 2%, which is typical for an S&P 500 fund, you would need $5 million invested to generate $100,000 annually in dividends. Conversely, if you invest in higher-yielding dividend funds or stocks that yield closer to 4%, you would only need about $2.5 million to generate the same $100,000 in annual income. As with any investment strategy, there are trade-offs. Higher-yield investments tend to have more risk, and you need to carefully evaluate each investment's ability to maintain or increase its dividend payments. Tax considerations. Dividends can be a highly tax-efficient source of income, especially when held in tax-advantaged retirement accounts like IRAs or 401ks. In these accounts, you won't owe taxes on dividends as they are paid out, allowing your investment to grow more efficiently. If you hold dividend-paying stocks or funds in a taxable brokerage account, the dividends you receive may be subject to different tax rates, depending on whether they are qualified or non-qualified dividends. Qualified dividends are typically taxed at the lower capital gains tax rate, while non-qualified dividends are taxed as ordinary income. It's crucial to consult with a tax advisor to determine the most tax-efficient way to structure your retirement investments. The sustainability of dividend income. One of the biggest advantages of focusing on dividends for retirement income is that you don't need to sell off your investments to generate cash. Just as you wouldn't want to sell a rental property to cover your monthly expenses, living off dividends allows you to preserve your investments while still generating income. Of course, no investment is completely risk-free, and even companies that pay regular dividends can experience financial difficulties. In extreme cases, a company may reduce or eliminate its dividend altogether. However, dividend payments tend to remain relatively stable, even during market downturns, making them a reliable source of income for retirees. It's also important to remember that the value of your dividend-paying investments can fluctuate. Stocks and funds may experience price volatility, which can affect the overall value of your portfolio. This is why it's important to adopt a conservative approach and ensure that your portfolio is diversified across different industries and asset types. Conclusion: a dividend-focused strategy can be a powerful way to generate a sustainable income in retirement without needing to sell off your investments. By investing in a mix of dividend-paying stocks and funds and REITs, you can create a steady stream of income that grows over time. While this strategy requires careful planning and an understanding of risk, it offers retirees the opportunity to live comfortably without worrying about outliving their savings. Start building your dividend-focused portfolio as early as possible, and be sure to consult with a financial advisor or tax professional to optimize your investments for retirement. By taking the time to plan now, you'll be better prepared for a financially secure and fulfilling retirement.